not. Ever hear on the news that the market is up or the market is down? What market are they even talking about? Most of the time, they're referring to a stock market index, and understanding these is your first step to becoming a savvy investor. Think of an index as a report card for the stock market. It tells us how a specific group of stocks is performing overall, giving us a snapshot of the market's health. So, why should you care? Because these indices are the benchmarks that help you measure your own investment success. Stick around and we'll break down the most famous ones and show you why they're so important. So let us start with the big one, the S&P 500. The name itself gives you a clue. S&P stands for Standard & Poor's, the company that created it. And 500 refers to the 500 largest publicly traded companies in the United States. We're talking about giants like Apple, Microsoft, Amazon, and Google's parent company, Alphabet, because it includes such a wide range of large, influential companies from various sectors like technology, healthcare, finance, and consumer goods. The S&P 500 is often considered the best single gauge of the US stock market's performance. When you hear that the market had a good day, it often means the S&P 500 went up. How is its value calculated? It's a bit complex, but the key thing to know is that it's market capitalization weighted. That's a fancy way of saying that the bigger the company's total stock value, the more impact its price changes have on the index's overall value. So, a 1% move in Apple's stock price will affect the S&P 500 much more than a 1% move in a smaller company within the index. This makes sense, as it reflects the real-world influence these mega companies have on the economy. Now, let's talk about the Dow Jones Industrial Average, often just called the Dow. This one is even older and more famous than the S&P 500. But here's a surprise. It only tracks 30 companies. That's right, just 30. These are what we call blue-chip stocks, large, well-established and financially sound companies that are leaders in their industries. Think companies like Coca-Cola, Walt Disney, and Johnson & Johnson. The Dow was created way back in 1896 to give a simple, clear view of the market's direction. The way the Dow is calculated is also different. It's price-weighted. This means that companies with higher stock prices have a bigger influence on the index's movement, regardless of the company's overall size. For instance, a stock trading at $200 per share will have twice the impact on the Dow's value as a stock trading at $100 per share. This method is a bit old-fashioned, and some critics argue it doesn't give as accurate a picture as the S&P 500's method. However, because it's made up of such huge, stable companies, the Dow is still a very closely watched indicator of market sentiment and economic health. So we have the S&P 500 with its broad view of 500 large companies, and the Dow with its focused look at 30 industrial giants. What about other markets? Well, there's the Nasdaq Composite. You've probably heard of this one too. The Nasdaq is famous for being very tech-heavy. It includes over 3,000 stocks listed on the Nasdaq Stock Exchange, and a huge portion of them are technology and internet-related companies. We're talking about the pioneers and innovators companies like Netflix, Intel, and Tesla, because of its heavy concentration in the tech sector. The Nasdaq Composite can be more volatile than the S&P 500 or the Dow. When the tech industry is booming, the Nasdaq can soar. But when that sector faces challenges, the Nasdaq can fall more sharply. It's often seen as a barometer for the health of the technology industry and for investor appetite for growth and innovation. If you want to know how the tech world is doing, the Nasdaq is the index to watch. Let's put this into a real-world context. Remember early 2020, the global economy was hit hard and stock markets around the world tumbled. The S&P 500 saw a dramatic drop. However, as governments and central banks stepped in with support, and as certain sectors, especially technology, adapted and thrived, the market began a remarkable recovery. By watching the S&P 500 climb back up throughout the rest of 2020 and into 2021. Investors could see the resilience of the US economy and the return of investor confidence. A line chart of the S&P 500 during that period would show a steep V-shape, illustrating the sharp fall and the subsequent strong rebound. This historical performance shows us how indices don't just go up. They reflect the economic cycles of booms and busts, and over the long term, they have historically trended upwards, rewarding patient investors. So, how can you, as an individual investor, use this knowledge? First, you can use indices as a benchmark. Let's say you've picked some stocks or invested in a mutual fund. You can compare your portfolio's performance to the S&P 500. Are you doing better or worse than the market average? This helps you evaluate your investment strategy. If you're consistently underperforming the S&P 500, you might need to rethink your approach. Second, and this is a game changer for beginners, you can actually invest in the indices themselves. You can't buy the S&P 500 directly, but you can buy an index fund or an ETF, which stands for Exchange Traded Fund. These are funds that are designed to mirror the performance of a specific index. For example, an S&P 500 index fund will hold shares in all 500 companies in the index, in the same proportions. But by buying a single share of this fund, you are instantly diversified across 500 of the biggest US companies. It's one of the simplest and most effective ways to start investing. And it's a strategy recommended by legendary investors like Warren Buffett for most people. Investing in an S&P 500 index fund means you're betting on the overall growth of the US economy, instead of trying to pick individual winning stocks, which is very difficult. You're essentially buying a small piece of the entire market. For long-term goals like retirement, this can be an incredibly powerful and low-cost strategy. The same is true for the Dow or the Nasdaq. There are index funds and ETFs that track those as well. To sum it all up, Stock market indices like the S&P 500, the Dow Jones, and the Nasdaq are vital tools for any investor. The S&P 500 gives us a broad, comprehensive look at the 500 largest US companies. The Dow Jones offers a more focused view on 30 industrial leaders, and the Nasdaq provides a snapshot of the innovative and fast-growing tech sector. They serve as a report card for the market's health, a benchmark for our own investment performance, and perhaps most importantly, a simple and effective way to invest through index funds and ETFs. Understanding them is not just about sounding smart when you watch the news. It's about making smarter decisions with your money. Thank you so much for watching. If you found this breakdown helpful and want to learn more about navigating the world of investing, make sure to hit that like button and subscribe to our channel for more market insights. Let us know in the comments which index you find most interesting. See you in the next video.